Welcome to Tradespotting. It's the balloon, the pin, and well, frankly, who's holding that pin? Why the markets could snap and where they're going if they do, if you hear a crack. Because traders are dancing on a very thin and bouncy tightrope that spans the mouth of a volcano. Tariffs are rising. I've been in London investigating how tariffs are impacting the bottom line ahead of earnings to get a read on the market and understand the consequences of any bad news, which I'm here to tell you today exists. S&P 500, you wouldn't hear a whisper of complaint from it, up very high, extremely high, 22 times forward earnings kind of high. As the planes come across the top, it's a helium balloon. It's drifting across a minefield, and all the bulls blissfully blindfolded by these stunning new highs. But somewhere out there is a pin, a sneaky sliver, a silver sliver of truth, sharp enough to sink this little boat we've all got going, enter those tariffs. Now, no one Trump threatens actually takes it seriously. But those threats of future tariffs aren't actually the problem anymore. It's the existing tariffs and the upcoming earnings. There's an awful lot of information here that we've distilled down to actionable advice. And you can sum it up like this. The Magnificent Seven are going to continue to do well. There's going to be an even greater broadening between the growth of those Magnificent Seven, the rest of the market. There subsequently is going to be a gap between that performance of the top stocks, everything else, and there will be a retracement to the median. This means that you might be protected in those top tech stocks, but not everywhere. Not all of your trades. Some of them will face terrible damage in order to bring the average results down as far as they're coming. So what's up in the markets? Duties, they're up 13%. They're effectively 5 times higher than they were this time last year already. That's currently going through the books. That's working its way into earnings, and we'll see that this week. 5 times what they were last year. It's not smoke. It's not just fire. It's napalm. And they've decorated the house with it. Talking about decorating houses, well, we'll get to that in a moment. Question being, at what stage of the cycle do we see them decorate the lifeboats? Corporate earnings, that's where the first Jenga block will fall. General Mills, they're playing chemistry chef just to offset their costs. Oxford Industries, 40 million slapped on the tab, coming through like a freight train. FedEx, buckling under the pressure of tariff-tangled trade routes. And that logistics element, a great read on the overall economy. If you remember, we talked about this exactly 6 weeks ago today. Even those Magnificent Seven might lose a little bit of their magic dust if the guidance slips. Netflix, they give us a really good show and then they tripped over their own expectations. Earnings aren't missing. They're just not good enough. That's the bottom line. Earnings are not good enough. And when not good enough, or good isn't enough, markets tend to punish you brutally. The Fed doing that decorating of the lifeboats, and the question then, what stage of the cycle do we see this happen when the Fed go in and start remodeling cold cup of reality? Trump still continues his juggling with the tariff deadlines and the amounts. Powell, meanwhile, duck, dodge, dive, duck. All the insults coming his way. The Fed instead have decided to patch up its physical fortress, a coat of fresh marble on the walls. Get that marble wallpaper out, Jerome, save a few bob. Retail sales look resilient for now. Sticky tariffs hitting those retail earnings. While they're still strong at the minute, we're going to see that weaken as time goes on. Another train? We are being really treated to it on Tradespotting today. It starts with Google. So don't write the rate cut in ink. It's not yet guaranteed. And if there is a rate cut, what do we expect to happen? I think the markets will dump on the news of a rate cut. I don't think it's going to be seen as good news. It's going to be an admission of failure, a cave to a strategy that's not led by the economics, and the markets will not trust it at all. So when America gets entangled with debt, it comes hand in hand with a heavy dollop of delusion. Europe, meanwhile, lounging like they're in Club Med, and I can tell you here in London it bloody well feels like it. ECB, European Central Bank, they know the waves are coming in, but they prefer to sunbathe and relax under their parasols until September. Strong euro, weak exports, and then France with fiscal fantasies, keeping things ticking along for the time being. But the Eurozone, a little bit dodgy here too. Say here, but we left, didn't we? As they arrived back in. Price to earnings ratios then. Frothy, inflation, sticky, and market sentiment is higher than a trader who bought Nvidia at the top. Somebody out there holds that silver sliver of a pin. It might be a weak earnings print. It might be a surprise tariff hike. It could be Powell blinking and caving to Trump's demands. And all of these things could send the balloon popping. And these traders, as I say, this bouncy tightrope, and it goes across the mouth of a volcano. Even bulls know when to duck, and that might be the time. So the market, certainly not dancing around to the beat of fundamentals. You have to focus on the charts. Those traders certainly are bouncing around, and crypto is offering the best opportunity right now, as we covered in a recent video. So those markets look like they're going up. Actually, it's a mime artist pretending to climb the stairs, and underneath the floor is actually disappearing as the Fed hammers new gold leaf into the walls. We have to ask ourselves, is this that moment when we see those lifeboats being decorated, and you know, if the rate cut comes, it won't be good news. So that's the long and the short of it. I've been in the trenches, literally here in the trenches, looking through the data, and I can tell you it's not good. Those duties are higher, 5 times higher. Earnings are good, but they're just not good enough under these circumstances, and there's likely to be a retracement. That retracement will come when SPY hits an important target on the RSI. That's in at around 69, 70, these sort of areas. Perhaps it goes to 71, but a huge retracement is potentially coming after that. I think the landing zone is not at this gap where most traders will be predicting to find it, but instead in at around 5,555. That's the Tradespotting prediction for the market crash, should it happen. It's the Magnificent Seven keeping everything afloat. So you need to be careful where that pin is hidden. If it's in one of those 7, well, we're all absolutely screwed. Unless we're in crypto, in which case, happy days. Hit that like button. On your way to the like button, hit the subscribe button if you haven't hit it already, and go down, leave a comment. Tell me what you like most about this video. The incredibly clear targets, the fact that it's based on specific data, technical analysis, which tells you where it's going and when. Are these your favorite parts, or was it the trains?